Well, the latest numbers from Realty Trac show that U.S. foreclosure filings hit a record 1.5 million in the first half of 2009. That's a 15% increase from the same period a year earlier. Rick Sharga, Executive Vice President at Realty Trac, has been closely monitoring U.S. foreclosure data, especially since the housing crisis began. He joins us now from Washington. Rick, always good to talk to you. So a record 1.5 million foreclosures. I mean, how does that break down? It's something like 1 in 84 households?
Exactly 1 in 84 households, and it's unfathomable that we're looking at these kind of records, no matter whether you're looking at the year or the quarter. We had over 890,000 households receive a foreclosure just in the second quarter, which is the highest quarter we've ever tracked.
How many homes right now are underwater?
That's a really good question, and depending on whose numbers you believe are most accurate, you're looking at anywhere from about 20 to 25%, but it's a significant number. Those households tend to be in the states that are already the most severely affected by foreclosures, and a lot of them are sitting on option ARM loans, which are due to reset next year, so the math on those doesn't look particularly appealing either.
So even sort of aside from the loans, what happens if home prices continue to fall, let's just say by 5%? What happens to that figure of underwater homes?
Well, obviously, the more price depreciation we have, the more homes wind up going underwater. The real trillion-dollar question is how many homeowners stay attached to those homes versus walking away and mailing the keys back to the bank. And the surveys that have been done so far suggest that if you're 10% upside down, you're very likely to stay and just kind of weather the storm. If you're 50% upside down, you're almost certainly to leave. And there's sort of a sliding scale in between that. So I believe that's why the administration has done what it's done in terms of increasing the loan-to-value ratio to 125% on its refinance programs.
Getting back to this idea of the adjustable rate loans, August 2011 is a key calendar point. Why is that?
Well, that's really when the peak of the reset period for these adjustable rate option ARMs is scheduled. And while there aren't numerically as many of these loans as there were subprimes, the dollar volume they represent is probably higher. So that gives you probably the time period during which we have to resolve this issue, or at least find some salvageable workaround to the problem before it all explodes.
Rick, you alluded to this earlier, but let's talk about the weakest spots in the country. I mean, have they changed at all in the last 6 months? Are we still just looking at California, Florida, and the Vegas area?
No, that's a great question. California, Florida, and Vegas, Arizona are certainly continuing to lead the pack. But we're seeing states that hadn't been foreclosure hotbeds jump into the tops of the rankings again. Places like Idaho, Utah, Illinois, Oregon's been in and out, South Carolina. And these are all states that appear to be affected mostly by unemployment-related foreclosure activity, as opposed to the fallout from the subprime meltdown and some of the kind of toxic loans that were out there.
Would you say, if you had to pin it on one key factor, the one that's keeping the housing market down, is it unemployment?
I think unemployment is leading to more foreclosures, and the sheer volume of foreclosures is what's probably keeping the housing market down. Right behind that, though, is the lack of available funding for people that want to buy these houses. There are hundreds of thousands of great buying opportunities out there for people who simply can't get financing.
Rick, we thank you as always. Rick Sharga, Executive Vice President at Realty Trac.